Hey everybody, good to be here today. My name is Brent Moores, and time to talk about advanced option strategies. We're going to continue on. In fact, we're getting kind of near the end of our series. Each week we've been covering, over the past 8 weeks at least, a different option strategy each week, and this week is no different. We're going to cover long and short straddles and strangles. We're going to discuss those. And those two are very closely related, straddles and strangles, which is why I'm coupling those together. And hey, it's good to be here. Glad to see some familiar names in the chat, and glad to be joined by Connie Hill, who's helping me out today in the chat. So as you have questions, feel free to type those questions in the chat between Connie and myself. We'll try and get your questions, and you can follow us on X at Brent Moore CS, at Connie Hill CS, and we post additional content throughout the week there. Remember, though, that options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation of any security strategy or chart pattern. And Schwab does not recommend the use of technical analysis as the sole means of investment research. The paper money application will be provided for educational purposes only. And let's see. I may not factor in commissions in all our trades. Just realize commissions are a factor that you should consider. All investing involves risk, including loss of principal potentially. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And there's no guarantee of an execution of a stop order at or near the stop price. So there we go. Let's head on over to the Thinkorswim platform. I'm not going to spend much time on the markets here. If you're interested in a more in-depth look at the markets as a whole, I'm teaching the Market Movers webcast today at 4 o'clock Eastern time. So feel free to check that out. This is the S&P 500 though. We're down a little bit over 0.5%. You can see, hey, we had that strong run, and now we've been kind of going a little bit more sideways. If I were to say what's the most immediate kind of resistance level on this, I'd probably call that. Most immediate kind of support level, I'd probably kind of call that. There's a little channel, I don't know how long it's going to stay in that channel, but those are relevant levels on the S&P 500. And as I mentioned, join me at 4 o'clock Eastern time for Market Movers if you're interested. But what I want to do is I'm going to go through initially kind of a quick review, like I've done each week for each of our series, each of our strategies, kind of just the basic parameters of the particular strategy that we're talking about today. And then I want to use some example trades to try and illustrate those. So without further ado, let's do it, folks. Let me head on over, and what I'm going to do is I'm just going to bring up a Word doc. I'm going to write out some stuff. We'll discuss it, and then we will get to the Thinkorswim platform and get some relevant examples here on this. But when we're talking about a long straddle or a long strangle, we're going to buy a call, okay, and we're going to buy a put at the same time. Okay, buying a call, buying a put at the exact same time and the same expiration. Okay, so that's how that works. Expiration right there. And that's for long. Now, I just mentioned we can also do shorts, a short. And in this case, we want big movement. And the key to this strategy is we don't care if the stock goes up or if the stock goes down. We just want it to go up or go down, one direction or the other. And just to give you kind of an illustration of how that would work is, I'm just going to use an example. Let's say we have a $50 stock, and we're using $50. So we buy a $50 call and we buy a $50 put in this case. And in this case, that would be a straddle. If they're the same strike, it's a straddle. If it's a different strike, it's a strangle. But let's use for our example, that's supposed to be a put, by the way. And we're going to say we bought each of these for $2. Okay, $2 each. Our total investment is $4 in that case. So let's just kind of visualize how this works. At expiration, if our goal is to make $4 or more, hopefully, or at least make up for the initial cost of $4, what price does the call need to be at in order to be worth $4 at expiration? Well, it's got to be worth, the intrinsic value of that needs to be $4, because at expiration there's no extrinsic value. So for this needs to be $4 in the money. So therefore our break even on this would be $54. Okay, I'm just going to write BE for break even. That's one of the break evens, because what's the put price going to be if the stock goes up to 54? The put's probably not going to be worth much. Well, at expiration, it's going to be worth $0 because it will be out of the money. What if the stock goes down? You'd get the same result. We have a break even. For the put to be worth $4, it would have to go down to $48. Excuse me. For the put to be worth $4, it'd have to go down to $46. Okay, so there's your break evens, 54 and 46. Now, we're not striving for break even, are we? No, we're not break even kind of people. We want better than that. So the higher this goes up, the more that call would be worth at expiration. That would generate a profit. We need it to go at least $4 to get break even. But if it goes up more the merrier, the more the better. Or if it goes down, we don't want it just to go to 46. We want it to go to 40 or 30 or whatever. The more it goes, the bigger it moves, the better it is. Okay, that's how that works. What if the stock doesn't really move much? What if the stock just kind of stays at $50? Well, what's going to happen to the call? The call is going to get wiped out at expiration. The put's going to get wiped out at expiration if the stock is at $50, because there's not really going to be much intrinsic value on either of those. And that would be the bad scenario. So when I say we want that stock to move a lot, that is why I mentioned that. We want big movement on that. Okay. Now, there's an alternative strategy where we can sell a call and we could sell a put, and with the same expiration, and that's going to be a short straddle. Okay, that's going to be a short straddle or a short strangle. What do we want? We want little movement. Now, there's pros and cons to each of these. I'm going to focus more on long straddles today, but I'll give you an example of a short one for the reason that there is some more risk, extra risk with that short straddle there, or short strangle. And we're going to talk about that. So let's do this. Now, one thing I should mention between the long straddle and the short straddle is this: your option approval levels are different. There's a different option approval levels. This is a Schwab page of Schwab option approval levels. And so if you want to do a long straddle or a long strangle, well, long straddles, level 1, okay? That's a long straddle, or a long strangle, level 1. No, that's the same as doing a long call or long put, okay? It's just doing those together. That's what we end up with. So many more of you are going to be approved for a level 1 strategy than a level 3 strategy. Short straddles or short strangles would fall in that category as well, because that's going to include things such as an uncovered call, a naked call there. So most of you, I will tell you, are probably not going to be approved for a level 3 strategy. That's another reason I'm going to focus on my long straddles today, not my short straddles. Okay, hoping that's making sense there. And let me go and let me get out of this. Okay, let's continue on. And just to clarify, that if you're using the same strike prices, strikes for what we've talked about, that is going to be a straddle. If we're using different strikes, that is going to be a strangle. Okay, we'll keep on moving down. These are, so it's vega is a consideration, implied volatilities are a consideration. It's vega positive for a long, if you're going long. It's going to be vega negative if you're going short. And so a lot of times this is a strategy that people will use before earnings, but that's kind of a key thing to remember. What happens with implied volatilities when earnings come out? Well, typically implied volatilities are going to drop. And that's kind of a headwind that works against you for long strangles and long straddles, is that vega, that they're vega positive in that case. All right. So let's move forward, and I'll hit up some of these questions here because there's some good questions that are coming in, and I will do. Let me just note here: IV changes can be significant, especially with earnings. Okay, and since we're talking about earnings, I'll look at one with earnings today. Then it's definitely going to be considerations. It's theta negative. Time decay will work against you if you're doing a long straddle. It's going to be theta positive. Time decay will help you out in the case of a short straddle. All right. Now, let me just hit up some questions and we'll continue on with the list. We're about halfway done with that list there on this point. Let's see. Ted says, so a short straddle looks similar to a calendar. Well, remember, there are some differences. Short straddles are similar to calendar in that they're both going to be positive theta. That's nice. You don't want the stock to move in either one. That's similar between that and a calendar. One big difference is, again, you have that kind of unlimited loss in the case of a short straddle. So that is a difference there between those there. I will, George is asking about the Analyze tab. We will get to the Analyze tab in a little bit there. George, we'll take a look at these here okay? Expiration. What expiration are you going to choose? Well, the expiration you're going to choose is you're going to choose the one for as long as you expect the volatility to last. So in other words, I don't mean the implied volatility. What I mean here is the movement in the stock. You're expecting, in the case of a long straddle, a big move in the stock. So if you're doing this, for example, before earnings, then you're probably going to choose a date that's after earnings for your expiration date. Doesn't need to go way past earnings because that's where the biggest move is. And if you're not choosing earnings, you probably have some idea in your mind of how long that volatility will last for. And then you'll probably just buy a little bit beyond that in terms of your expiration date. Okay. Typically, we're going to do these at the money. Okay. For a straddle, in terms of a strangle, we may just go a little bit in the money and a little bit out of the money on those. Okay. Excuse me. In the case of, you may go in the money on both of those because the call is going to be out of the money on both of those. The call on a strangle, if you're doing a strangle, you may go one strike out of the money, maybe two strikes out of the money. The put on a strangle, you may go one strike out of the money or two strikes out of the money, but typically we're kind of centering it at the money. If you move it from at the money and your center point isn't at the money, then you can polarize the trade a little bit. In other words, you can make it a little bit more bullish directional, a little bit more bearish directional in that case. If you're doing long strangles or straddles, then these are going to be kind of lower probability trades, potentially big rewards. Go into that example I gave earlier of that $50 stock. If it moves up, the more it moves, potentially you can make a whole bunch of money. Or if it goes down, but because that time decay is working against you, and and if the stock just kind of stays put, it's not going to be a higher probability trade. Generally, it's going to be a lower probability trade. Short straddles and strangles. Just to reiterate something I mentioned before, unlimited risk. That's why we're going to avoid these for the most part in this class. Okay. So when are we going to exit? I think I already said this. Exit after vol event. For example, earnings. Okay. Well, we're not going to keep on holding on after that, probably. At least in this class, that's how we're going to deal with it. Of course, you can have your own rules in terms of when you want to trade. And ultimately, you don't know. I mean, only hindsight will tell you when the best time to get out of a trade is. And I just got a couple more items here. Oh, you can exit. You can exit with stop and limit orders if you want. Okay, keep in mind when you do that, reward to risk ratios. Also, this is a good time to remind you, you can't get out of the risk on the trade just because you put in a stop order on that. Let's say we do a long straddle and we put a stop in at, say, I don't know, 50% or something like that. Does that mean we're going to get stopped out right at 50%? No, stops aren't guaranteed. And let's say we had an earnings and the stock just did nothing on earnings. We may very well exceed that 50% stop loss on there. So you just need to be careful on that. I think I had one more, and that is just money management. It's the same as we do for most of these. I'm going to say 1 to 2% of active portfolio risk. So we're only going to risk 1 to 2% of active portfolio, for example, in this class. All right. Now, that's the document I just did. Okay. I can't share that with you. I can't send it out, but you are welcome to take notes. You're welcome to take a screenshot, whatever. You know, I'm not going to stop you from that. If you're watching on a recording, you can pause it, you can write it down, but just remember, these are not recommendations of exactly how to do it, but these are guidelines we're using in this class here. All right, I'll leave that up for just one more sec. But I want to now transition to the Thinkorswim website and take a look here. We're actually mostly past earnings season, folks. If we go to MarketWatch and calendar, look, we're at the end of May. What's today? Today's the 30th. We just had these. And so next week, this is just S&P 100 stocks, but they tend to be more liquid, which is what we're looking for. We have Broadcom, we have Oracle next week. Broadcom and Oracle next week. So Broadcom on the 5th. Broadcom on the 5th, AVGO on the 5th. Let's look at a long straddle. This one I'm going to use earnings. You don't have to do earnings, but this one I want to just as an example use earnings, an earnings trade. AVGO, because that is frankly a time when a lot of people will do this. Here's our expiration date on the 5th. And let's just kind of look at, let me just pull up the implied volatility here first of all. Remember, we benefit on this in the case of a long straddle if the implied volatility doesn't like crash on us, if it doesn't tank on us a lot. We had this kind of higher level implied volatility, but that's when the whole market was kind of going bonkers. And certainly, I wouldn't expect implied volatility to go higher on an earnings, and it's probably likely going to drop after earnings. But if you look where we're at and you kind of see the low point, say after last earnings around 43, it's not a massive drop in implied volatility. So that potentially could help us on this AVGO trade. All right. Now, let me go to trade. Here's AVGO. Let me get rid of that. I actually have a position on AVGO right now, but it's a different position. So let's just take a look at this. Okay, now, so we got earnings. When's our expiration date? We said our expiration date was the 5th. So I want an expiration. The expiration I'm going to choose is going to be after the 5th. We have next Friday, June 6th. Okay. And what's our straddle? Well, let's look at our straddle. A long straddle means we're buying the call and we're buying the put. We're pretty close to a 240 stock price here on this. So I'm going to look at that 240 call. I'm going to look at that 240 put. How much is the straddle going to cost? It's going to cost basically this plus this, okay? About 1935 or so, okay? Price is going to move around. That's how much that is going to cost. Sometimes when people are trying to anticipate how much movement a stock is likely to have, they'll say, look at the long straddle price. Well, you can do that. Of course, you could change this from single to straddle. And if you do so, it's going to show exactly that. In fact, let me just show you this. If I change this to straddle, which is right here, and I go to that 240, you can see that price right there. That is just adding the call and the put together. In fact, if I click on this, it brings up the 240 call, the 240 put. That's what it is. Now, that's one way of doing it. That's one way of kind of anticipating how much this stock may move. Another way is you can go over here. This is look at the implied volatility on this contract. And there is, in parentheses, that's kind of giving the expected move, plus or minus, we don't know which direction, of about $19.50. So remember, our break-even point is going to be the straddle price plus or minus the stock, or the stock plus or minus the straddle price. So just under $20. Let me go back to, let me just do a plain chart here on this. Plus or minus $20. Well, what's plus or minus $20 here? I'll use yellow on this, okay? The stock's just a little bit below 240, so $20 move down is going to be just a bit below 220, okay? And plus $20 is going to be just a bit below 260, right about 260, okay? We'll say that. This is the setup for the trade. This is the expectation for the trade. If you think the stock is likely to move above this yellow line or below this yellow line after earnings, then this may be a trade that is of interest to you. If you think the stock is likely to stay within these bounds, this trade is probably going to be a lot less interesting to you. Now, is the stock going to move beyond that? I don't know. I don't know the answer. But this is because this is not a recommendation on this particular stock. And certainly there's always going to be that element of uncertainty there as we talk about this. But so what I'm going to do is we're going to demonstrate this trade here. Now, let me go get out of my drawing tool for a sec. And when are we going to get, if we enter this trade, when are we going to get out? We're going to get out after earnings, right? After earnings, the stock is likely not to just stay put. It's likely to go way up, or way down, or maybe up a little bit or down a little bit. Hopefully it's the way up or way down. But if it goes way up, the put is probably going to be pretty close to worthless after earnings. But the call will likely go up in price. Hopefully it goes up more than enough to make up for the put. Okay. And vice versa in the case of if it goes down there. So let's go to, let me go, and George before was saying, let's talk about the Analyze tab. Okay, so if you go to the Analyze tab, one thing you can do is you can go to the Earnings sub-tab here, okay? Analyze, Earnings sub-tab. If we're looking at AVGO, what we can do, you're maybe going, well, how much in the past has it moved after earnings? Well, you can go here and you can look. This is each of these little windows, I don't know what you call them, columns, represent a past earnings event. And you can see what happened over time here. This is the stock price. What did it do before earnings and what did it do after earnings? It went from 191 down to 179. That was about a $12 move on earnings, okay? In this case, go back a quarter, it went from 180 up to 224. That was like a 40-something dollar move in earnings. So this just gives you a little snapshot. You could do this on the stock chart itself if you wanted to, but this kind of just neatly puts it all in one area. You can also see what implied volatilities did after earnings and see how much they've dropped after earnings. That's this kind of reddish line. The more yellow one is the historical volatility. And historical volatility is the volatility showing the current movement on the stock, and it jumps up after earnings, as you'd expect. Implied volatilities drop after earnings, as you'd expect. Here's your at-the-money straddle price. For some reason, it doesn't show these here. It doesn't have those, but here you can see what the at-the-money straddle price. We already looked at that on the other page, but you can see how that price dropped after earnings, that at-the-money, because the implied volatility is out of that trade, right? And you can actually, this last one down here is just showing what the earnings were in relationship to Wall Street estimates. The green is the estimate, that's the yellow there. So I don't know that this trade page is necessary for you. You can get this data looking, well, at least the stock price data, and looking at the chart itself, but some people find it helpful there. Okay, so here's AVGO. Now, as I mentioned, I have another trade on here, and I haven't actually entered this trade yet. So let me go back to there, and here's AVGO. I'm not planning on putting in a stop loss on this or a target. I'm just planning on managing this as after earnings comes out. All right. So let's do this. So Chris, I'll address that question here in a sec. Let me send this order though. It's at the mid price, and let me confirm and send, and send that. Okay. All right. Let me, I want to look at another one here, and we'll go back to that, and I'll look at that as well. But we have AVGO, we've just entered that. Let me pull up another one that's not an earnings example. Now, if you're not doing an earnings example, your earnings just passed on CVX. This is Chevron, okay? This is Chevron. And here's my theory on this. And you can use technical indicators to help you, volatility type technical indicators to help you. One that I'm going to do here is I'm going to go to Bollinger Bands, okay? I'm going to throw this in here. I'm going to apply that, apply this. And this is a common kind of volatility indicator. And the way a lot of people will use this is they look for what's called a volatility squeeze. Okay, so the width of the lines, here we're talking about this red line, I'm kind of marking over with yellow, and the purple line, you'll notice they widen out during periods of big volatility. Okay, big volatility here, we had big moves here, right? And so they widen out. And then at times it constricts, okay? And we'll call these volatility squeezes, okay? And so what traders will do is they'll look at a stock and they'll say, look, right now we have kind of a squeeze. Implied volatility is lower, or volatility is lower on the stock. This is actual volatility. But the theory is it's not going to stay lower forever. When it squeezes, it tends to revert from squeeze to bigger volatility move. And even without the implied volatility, not implied, without the Bollinger Bands, you can see it kind of moves sometimes. Periodically, it makes big moves, and then periodically it goes sideways. Well, right now it seems weird being a sideways move. Now, do I know if this is going to move a lot? I don't, but I'll tell you what, there's something to be said, I think, for oil and global uncertainty and economic uncertainty and how that oil can move. And that can certainly affect a company like Chevron Texaco, okay? So that's the theory on this. I'm going to look at, again, I'm going to do a long straddle on this. But in this case, there's no earnings that we're going to deal with. So we got to decide, how long out are we planning on holding this earnings for? Okay. And not earning, I said that wrong. Not how long we're holding the earnings for, how long we're holding this straddle for. Our plan isn't to hold it necessarily past earnings, but we're planning to hold it. I want to give it more than a couple weeks. Maybe we look out a couple months here on this to do this. So what I'm going to do is I'm going to go to the trade tab. I'm going to go to CVX, and I'm going to go to, I'll go to the monthly contracts. One advantage of the monthly contracts, this is almost 2 months out, so this is a ways out. You don't have to do that. You do tend to get better liquidity on these here. All right, let me go back to single for a sec. Okay. And I'm going to go at the money again. Typically we're looking at the money. At the money, we're going to call 135. That's the closest we can get there on that. And we've got about $11 move on this. Okay. Now let's go to Analyze tab again. Okay. We're going to go to Analyze tab. We're going to go to earnings on CVX. Okay. So what happens is the at the money straddle, you'll see always drops, okay, after earnings. And that is because there's a new straddle. There's a new, this is what the price was for the straddle. But once we have once the stock moves up or down, the new straddle, remember the straddle is the at the money contract, at the money. If the stock is going along and the stock goes way down, what's the at the money contract? The at the money contract is a different contract, okay? So the price is always going to drop, well, not always, I guess, but usually going to drop after earnings there on that. But this is not indicating the price on your trade, what it is doing there. To actually find the price on your trade, what you need to do is, you may, like, if you want to back test that, you may want to go to ThinkBack, okay? And I did a session on ThinkBack not long ago, like a couple weeks ago, I can't remember, I think the managing an options portfolio class, if you just put in ThinkBack in the search tool on YouTube, on the Trader Talks channel, you'll see that page come up, and you can use ThinkBack. That's probably the best way to decide how past performance would have done if you did a straddle at that time. But let's do this. Okay, I'm going to enter a trade. I'm going out a couple months, and I'm going to switch this to straddle. Now, I could, of course, just do long call, long put at the same time, right? Stock, we're going to say 135 is there. It doesn't matter whether I click here or if I click over here on the put, it's going to give me the same thing, okay? Call put. But I'm going to put in exits on these. These are ones where I don't have a definitive event. I'm just going to sell it out. So therefore, what I'm going to do is I'm going to make it a first triggers OCO order. I'm going to right click on this. I'm going to create an opposite order to get out. I'll duplicate that, so I have two of those. One of those is going to be a limit price. I'll leave it that. I'm going to make it good till canceled. And one of those is going to be a stop price, and that's going to be a good till canceled order as well. Let me just kind of shrink this down here. And I want to show you, let's see the full price here. What's our price? Okay, so our price right now is 10.35. That's the mid price. Maybe we'll go in like 10.30 is probably more realistically where we're going to get out there. Okay. So let's do this. Now, so in terms of a target price, I'm going to go for about a 50% gain on this. Well, about a 50% gain on $10 would be about $15. Now, if I do 10.30, maybe it's a little bit more than that. It's about 15, I think, if I'm doing my math right, my mental math right. That would be my target price. That'd be the good scenario. Going down, I'm going to look to sell, and I'm going to go down about 30% on this. I'm going to keep in mind my reward to risk ratio on this. So I'm going to go about to $7 here or whatever. Okay, I want to keep that reward to risk ratio positive on this. Does it mean we're going to get out right where the stop price is? No, it does not mean that. So just be aware of that. Also, remember, short options can be assigned early, but these are not short options. That'll be more in play when we get to our short example here coming up in a minute. We control the exercise on these. So I'm going to click on confirm and send. I'm going to send that order, and it's thinking. Okay. I'd like this to fill just for our purposes, our money management purposes. So I may cancel and replace that and see if I can, yeah, the price has moved up a little bit on us here. See if that'll work. There we go. There we go. Okay, let me see if I can hit, actually, let me hit another one and then we'll get to questions. I'm going to go to UNH, okay? As an example of a stock, I still have Bollinger Bands on. This is an example of one where I'm going to say, hey, look, we just had the big volatile move. The expectation is, for our purposes at least, now I don't know, but for our purposes, I'm going to say it's going to settle down a little bit and it's not going to move much. Therefore, maybe what we do is we look for a trade that is not going to move as much. So what I'm going to do here is I'm going to go to trade, UNH, and I'm not going to go out quite as far. We'll go out just over a month maybe. I'm going to do a short straddle on this. Strike is about 301. We'll do strike is 300. Click on this. Now, let me go to UNH and just show you the challenge here on this. One sec. Get rid of that. Oh, I need to analyze it. Analyze trade. Okay, here we go. So this is the challenge on this short straddle. Do you see what happens? The further we go down, okay, the further we go down, we lose more and more and more and more. Eventually, there is a limit, but it would be a really big limit of amount you'd lose. Basically, the amount of 100 shares of a $300 stock. The more it goes up, the more we lose, okay? So, and that's theoretically an unlimited loss. You got to be careful on those, okay? So typically I don't even teach these much. One thing you can do though is you can go here and you can say, look, instead of actually, you know what I want to do? I want to do a string. Let me see. Do I have time? Okay, I'm running out of time, but let me do this. It's the same thing is true, by the way, for a strangle instead of a straddle. So on the call side, what I can do is I can go, and I'm going to just use my delta, and I'm going to go to about 330. I'm going to sell that on that side. Okay. I'm going to go to something in my around 20 delta or so, and we'll go to about 21 delta. I'm going to sell this on this side. If I analyze this trade, and let me get rid of the initial trade I'd put in. I don't want that anymore. Okay, so how does a straddle and a strangle look differently? Do you remember on a straddle, it looked like this. On the strangle, it looks like this, okay? So that's kind of how it looks. We spread it out a little bit on those in that case. So that's your, in the case of the short strangle, the issue is still the same. The risk is still the same. So one thing that you can do is you can say, look, I'm going to add some protection, so to speak, on this. We did a 275 short put. What if we throw on also a 270 long put? Okay. And we did a 330 short call. What if we put on a 335 long call? Now, when we look at this, and I click on Analyze Trade, and I look at my risk profile. Let's see, I got to get rid of this now. Now it looks like this. Do you see what happened to our risk? Our risk, instead of going down forever, it caps it out. Now, is this a short strangle? No, this is no longer a short strangle. We just changed this short strangle into an iron condor, as Ricebird correctly pointed out in the chat. You're correct, Icebird. Yes, Ricebird. That is how that works. So you'll see in classes, webcasts that I teach, I demonstrate iron condor some. You'll see the same thing from Connie. Connie teaches iron condor some. You'll see we don't demonstrate short strangles or short straddles that much just because of that risk element on there. So there we go. Now, what I can do is I can put this in, I can confirm and send. And now, when would I do that? I'd only do this trade on UNH if I think it's more likely to go sideways than a big move here. So today, what did we talk about? We talked about straddles and strangles. We talked about how straddles, same strike, strangles, different strikes. We gave you an example of each of those. We talked about long. If we go long, we're expecting a big move. But time decay and volatility can work against us in that case. Especially in the case of an earnings where the implied volatility is likely to drop. We talked about short straddle strangles where we want a short move, not much of a move. We want a small little move. Time decay may benefit us, but the challenge is the loss potential on those trades. Okay, hopefully that's all. I'd encourage you to test it out on paper money, everybody. That would be my recommendation to you. Try it out on paper money, not in your live account, but in paper money there. So let's see. Yeah, Chris, I'm just trying to go back one because I'm just about out of time, but let me just see if I can address any questions. Chris said, if you're doing an earnings straddle, a long earnings straddle, when is it best? Before implied volatilities go up? Yeah, if you think there's going to be a spike in implied volatility soon before earnings, sometimes the implied volatility hike is kind of this low gradual affair, and really you're not getting much benefit. You're actually losing more from time decay than you are getting from benefit from the increase in implied volatility. So it may not work out, but if you expect a kind of a bump in implied volatility, a significant bump in implied volatility a couple weeks before earnings, then yes, do it. Plan ahead on that, absolutely on there, okay? All right, everybody. Thanks for joining me today. And coming up next, we've got ThinkScript studies. Reminder, 4 o'clock Eastern time. You'll see me again at doing Market Movers. So thanks, Connie, for helping me out today. Everybody have a wonderful rest of the day and nice weekend.